Can I have your attention, please, as we move on to the next panel on climate investing? This is actually on tech investments, and I'd like to call Anisha Singh, founder, She Capital, Anuradha Ramachandran, managing partner, TVS Capital Funds, Anupum Khaitan, ED Capital Square Partners, Nitin Sharma, general partner and co-founder, Antler India, Vikram Gupta, founding and managing partner, IvyCap Ventures, Priya Rajan, managing director, Silicon Valley Bank. I request the backbenchers to please come in front and take a seat. These people talk a lot. Okay, I see some movement.
Nitin.
All right, Priya, take over the stage
Awesome.
and deep dive into tech investments.
Perfect. Thank you. Thank you. Thank you to the IVCA team for putting in yet another incredible event. Rajan and team always do this. So once again, thank you for this, esteemed panelists today for spending some time with us. 2022 was not as equal to what 2021 was. The VC investments were down overall globally, and India was not immune to it. If you look at VC investments, it was down approximately 38% year over year, though the big chunk of it was in late stage portfolio companies. So today, our panelists have experiences all the way from, I would say, pre-seed and even earlier than pre-seed, to all the way up until buyout and growth in late stage. So we're going to get some perspective about what does that mean, just a quick look back into 2022, but also what does that mean for 2023. Before we start, my name is Priya Rajan. I'm Managing Director at Silicon Valley Bank, and I oversee the India and Middle East North Africa market for the bank. We work with funds and founders from here that expand into the US market. So if any of the folks who are here would love to learn more about you and see how we can explore collaboration there. With that said, maybe I can ask each of you to kind of quickly introduce yourself, your name, your fund, and what you do as a part of the fund.
Thank you very much, Priya, for the warm introduction, and thanks to the IVCA, Rajat, Amit, Akriti, Shreya, a whole fantastic group of people who have organized this year after year. And so this is actually, my introduction. This is my first time in India in the last 5 years, actually, since the last IVCA conference back then. And the reason for that is because I think India is starting to see tremendous opportunity in front of it. And it's something which you all know and have seen and heard previously. So, and with that said, name is Anupum Khaitan from Capital Square Partners. I'm an executive director there based in Singapore. Our strategy is exclusively in the technology buyout arena. And the fact that I'm here and that there's a lot of opportunities here in India, I think is a testament to the opportunity ahead of all of us. So thank you very much for joining us today.
Hey everyone, Anisha Singh. I run a fund called She Capital. We do cross-sector, cross-stages, but we write small checks. And I don't think I need to explain what She Capital does. It's pretty obvious in the name. Prior to this, I founded a company called Maidala, and I ran that. So moved from being a founder to a funder. I still consider myself a founder first. That's broadly us.
Thank you, Priya. Thanks, IVCA. My name is Nitin Sharma. I'm the co-founder and partner at a fund called Antler India. Been a VC for most of the last 15 years across stages in the US and in India for the last few years. My focus right now, and Antler's focus right now, is what we call the -1 to 0 and then pre-seed to seed. So we are largely in the business of creating companies rather than just investing in deal flow. And a lot of the pain points that we are trying to solve are range from helping these founders think global from day one, find co-founders and start companies. The fund has invested so far in about 32 companies.
Hello, everybody. Thank you, IVCA, for this opportunity to be on this great panel with lovely panelists. And it's great to see many of my old friends around as well. I'm Anuradha. I'm Anuradha Ramachandran. I'm currently managing partner with TVS Capital Funds. We are a mid-market PE fund. We invest right now in tech-first companies, which are either in the financial services sector or in supply chain management. We're in the process of also raising our next large fund, which will expand the scope a little bit more and invest more in B2B commerce as well as in SaaS, in addition to fintech as such. Our check sizes are typically in the range of about like $20 to $25 million.
Vikram Gupta, founder of IvyCap Ventures, primarily a domestic venture capital fund. We're currently investing from our Fund 3, which is a 2,000 crore size fund, all domestic. And our average ticket is about, Series A is our sweet spot, but we invest anywhere between seed to Series B from 1 crore up to 50, 60 crores. We're currently investing on an average of 50 crores in Series A checks. We are sector agnostic. Thank you.
Great. Thank you. As you all can see, I think we have a really good representation across stages. So I'm going to kind of break down the questions a little bit. But before we do that, a quick, your predictions into going into 2023. We talked about the numbers, obviously, slow from 2021 to 2022. How do you see in each of your investment kind of portfolio and thesis, how do you see 2023 evolve in terms of funding? Maybe Vikram, we'll start with you.
So I think, first of all, 2021 was an aberration. Actually, if you look at the bar chart, clearly 2021 will look like a huge, tall bar out there from the overall funding perspective. So, but if you just plotted the seed to Series A funding, that chart will look like growing over years, which means it's actually scaling up. So I think the biggest challenge was more in the late stage deals, which actually came down. So therefore, we are seeing a substantial growth, and I think what we were seeing as the data from one of the venture intelligence reports, I think you're talking about roughly about $4.5 billion in early stage when you're talking about seed to Series A kind of investments is growing from 2 billion to 4.5 billion over last 2 to 3 years. There's substantial growth in that sense. Of course, there has been a significant impact on valuations. We've seen how the market has changed and why there was a substantial growth in 2021 also, because a lot of money was printed in the US in 2020 after the COVID. But I think after the inflation shot up substantially, people started pulling back. And I think what we are expecting is that, Series A will continue to scale up. We are already seeing very, very attractive opportunities for investments. The valuations have got corrected quite substantially, which is actually very good for the system. We are quite excited about, and especially if you're sitting on capital right now, this is the best time to actually deploy.
Yeah, awesome.
So we've consistently been like conservative, thoughtful investors, and typically we invest in about 2 to 3 companies in a year. The last 2 years have been aberrations for us in the sense that we've gone up to 4 in a year. But that's how we will kind of continue to operate, right? An investment a quarter is what we aim for, and most often they're not hit. Our check sizes have been more or less also consistent between about 15 to 20 million. As we move into our new fund, it's likely that we might go a little bit early, so that we're able to kind of find great opportunities at a slightly earlier stage. That doesn't mean too early. It still is post Series A. So maybe like about $10, $15 million checks as opposed to the 20, 25 million that we usually do. So we are pretty excited about what we see around here because, as he said, valuations have corrected. More importantly, it is that everybody's mindset is on unit economics and profitable businesses, which gives us a pretty good sense of how well the country and the entrepreneurial ecosystem is taking this as such. So we like that part of it. And financial services consistently has been the biggest opportunity set always, and we think it will continue to be.
And Nitin, and would love to hear, Anisha, if you guys want to add more to it, but I also have a question in regards to the LP sentiment towards this. Yeah, please do.
I think when you invest at such an early stage, the game is actually different. So
Right.
we define our game not as valuations or what corrections in the market, but fundamentally are enough great people starting companies to solve problems in India, and are they thinking big enough to go global? And I think that is actually happening. So while the rest of the market is slowing, we are actually speeding up. We did only 2 investments in the first 6 months of last year. I think we'll do about 20 in the first 6 months of this year. So literally from 2 to 20. And I think valuations also really don't matter beyond a point as long as great people are starting companies. We've just crossed about 25,000 people who've applied. So I think the funnel of entrepreneurship in India is bigger and brighter than ever. And everyone knows this stat that recessions are about, or slowdowns are about 10% of economic history, but about 1/3 of Fortune 500 companies or large outliers get started during those times. So we could not be more excited.
I mean, clear shout out to Tejas, a 14-year-old that you invested
16.
in. He's
16, not 14.
16? Okay, when I met, he was 14. But, incredible, right? Just the brilliance of young founders that you believe in. So, Anisha.
So Priya, I think it's a great time, right?
Yeah.
Because there were founders that were walking in, and I don't know what they were smoking, all right? Because there was some serious rubbish happening in the market, all right? There was, this correction needed to happen. And now that I'm on this side, I kind of like it.
Yeah.
Because when you're on the founder side, of course you're annoyed. But everybody started marking their self-worth to a valuation, which was weird. Because you walk in and everybody doesn't rely, it's like the woman who swallowed the fly, then had to swallow the cat to kill the fly, all that. That valuation is not the mark you're setting to yourself to. There are investors coming in, and nobody seemed to realize that. All everybody was talking for the last 2 years was a valuation game.
That's right.
So I'm super excited about this time because this market reset had to happen,
Has
and
to happen.
founders had to get real. But also for the first time, they're talking unit economics.
Yeah.
Everybody's more conservative. Everybody who's talking now talks, how are we going to be more profitable? What are we doing to make sure that that exists? So I think it's a great time. Plus, I invest in female founders. They anyway tend to be very conservative, and they've got their capital running a long way. So that's good business anyway.
Anupum.
Yeah, well, so we invest in a different part of the ecosystem, which is in the leveraged buyout side. And because of that, we're primarily looking at companies that already have cash flow, that have resilience to withstand times like these where capital markets are not necessarily available to all equally. And as a consequence of that, valuations have actually stayed relatively more or less on par with where they were previously. Expectations have been basically based on a zero interest rate environment that we've been living in for the last 15 years based on the US dollar and the Fed. But that ultimately means then that when we're looking at companies, it's really about the intrinsic value within them, about the growth capabilities within those companies, but also the ability to generate cash flow and ultimately withstand market shocks, if you will. And so that's what we're seeing today. I mean, that's not to say that there aren't founders or promoters who do want to relinquish control of their companies for one reason or another. But we are seeing, relatively speaking, in the buyout side at least, valuations more or less for quality companies actually stay the same, relatively speaking.
Thank you. Just double clicking on the LP sentiment. We hear that there's a lot of dry powder available, waiting to be deployed. But there's also an element of what LPs are asking you guys to do. So maybe breaking it down to early stage and kind of growth and late stage. Maybe Anisha and Nitin, you can talk about what is expectations? Has the expectation changed, or of you going into 2023? Is the ask different from what it was before?
Well, see, my fund is an anomaly, right? So because it's a gender fund, it was a tough sell anyway.
Yep.
People used to think it's an NGO. Every time we walked in, everybody was like, oh, it's such a great nonprofit. So going from there to actually proving women are great business has already started happening. We're seeing so much happen around that, and plus we've already given exits, everything. So that puts us in a better situation. So as far as LP sentiment is concerned, I think starting from ground zero going up for us is brilliant. Is it slowing down? Yes, we're hearing that across the board, but I think broadly, at least domestic, is still at a certain threshold, and you're seeing that happen.
Nitin, anything on your end?
Yeah, I think if you divide it into sort of the sentiment around India, I mean, we don't have to sell India. A lot of our LPs are noticing how India has gone from, not just services to products, but you have platform companies now. When I moved back from the US my first few years, everything was X for India, right? Founders were basically copy pasting something, Tinder for India, Uber for India, and a lot of it was, I don't see that at all anymore. I can't remember maybe last time I've seen something which is an exact copy. So I think more boldness, younger founders, more founders from tier 2 cities, all of those things LPs are resonating with. The challenge really is to establish your own differentiation as a different product in the market, because there are so many people investing at this stage. So how do you create a platform and a product is really what the conversation is. And yes, of course, the fundraising from the first stage to the seed is certainly taking longer. More mortality is not the issue, but it is certainly taking longer, and so that's something we work a lot with our companies on.
And Anupum, from your end, on the growth stage.
Yeah, so on the buyout stage, because we are exclusively tech focused, you know, we're not being asked to do anything different other than find good quality companies, or companies that can aspire to be good quality companies, and those are called special situations when we get involved into them, and really go in there and be able to fix and help, you know, right-size the company, so to speak. But we always look for companies that have the potential to be high-quality companies. We're not focused as much on growth as we are on cash flow metrics. And from what I've seen so far, LPs are telling us to continue on with that strategy ultimately.
Vikram, did
No,
you
I
wanna
just
add
wanted to add purely from domestic LPs perspective, because we've raised funds from domestic investors, and these are predominantly institutional investors. These are the 70% of our capital actually institutional capital. You know, domestic market actually is slightly different as compared to the global markets. There's a big difference between institutional LPs and family offices, even in India. So I think it's and then again, depending on are you raising your first fund or a second fund or third fund, again, there's a big difference. Right. So from 240 crores to 530 crores, and we went to the market to raise 1,500 crores. Most of our existing investors came back and invested in the first fund, which is first closed at 1,600 crores. So I think a lot depends on your performance and also what kind of investors you're going after. So I think it's a function.
And if it's a follow-on LP versus a first time, also they have a confidence in what you guys do. Three sectors that kind of continues to take the bulk share of investments are the fintech, e-commerce, and enterprise, the one we're very close to on the cross-border side. Across the stages, would be great to hear where you guys leaning in this year. Maybe like Vikram and Anisha, you can talk on the early stage, and Anuradha, you can talk on the growth stage.
Well, we're doing everything, right?
Yeah.
Cross-sector.
Yeah.
We've done a lot around consumer. We continue to be excited about that, but I think in some sectors within consumer, it's overplayed, right? It's exactly like what he said, where you were kind of imitating models from the US. It's similar, right? But there are a lot people still doing very, very amazing stuff in the consumer space that I think will just blow up. We're looking at fintech, okay, with different twists, obviously, and innovation, and there's amazing stuff happening there. So we're just investing in a company that's doing health/fintech, which is interesting for us. Another thing that we're excited about is rural, okay, and we are looking at people do that. That is a problem in a market that is still being solved. There's a lot of discrepancy, a lot of organization that needs to happen there. We think it's going to happen and somebody's going to have to do it. And so we're looking at companies aggressively there.
So we are sector agnostic as well, but we look for disruptive business models early on. And since we look for substantial stakes in companies, 20 to 30% is the range of stakes we look for in these companies. Therefore, pre-series to series A is what we look for. So for example, when we invested 15 crores in Purple, we took 30% stake. Same thing in Clovia. We are doing something similar now when it comes to InsurTech, agri-tech. We're looking at a lot of very interesting investments in agri-tech space. And also on the consumer side, we're actually looking at some very interesting models right now. So of course, tech on the AI side and on the IoT side, we're actually looking at some very interesting business models.
Anuradha, and one question for you as a follow-on is over-indexed. Where do you feel, given your check sizes are much larger, where do you feel the market is over-indexed that you want to kind of stay away from for this year?
So we, as I said, we are predominantly financial services investors. And if you look at the financial services investments, most of them are looking at lending, right? And after lending, there was actually like this layer of technology which in different ways got called neobanks, challenger banks, etc. Lending continues to be a big need in India. There's no doubt about that. And actually, it's grown very well. And if you look at the banking system, they're actually also, like moving more towards consumer as opposed to retail, as opposed to being like more business oriented earlier. So while it is a large segment, it's not yet over-indexed. On the other hand, when we're looking at platform plays yet, there is still this need to prove a business model. So that's one segment that we're a little bit uncertain about, right? Like the neobanking, be it for small businesses or for retail individuals, there's still a long way to go before it becomes a true business model as such. So that's one segment that is a bit of a question mark for us. Otherwise, actually, like there are many real problems being solved, and as she was saying, like rural is one big segment, which, like we tend to think of India in two things, in two sides, right? Like there's India and Bharat. Yeah. I don't believe in that anymore, especially after our last investment where we went to this like completely remote area and he pulled out a QR code and that's how I paid, right? Like so. There's no India and Bharat anymore, but the way that actually like investments have flown through, it's kind of like been centered around the top cities and the top tier people. I think it becomes a little bit more democratized and the mass kind of like starts entering the market more vigorously, but with the right kind of products. And that's actually like where most of our work is being done currently. Just one more thing, referring to your last question around the LPs, we have our LPs tending to co-invest with us in each deal that we do. So we have something which is known as a co-investment portfolio by itself. And in this current market with these kind of themes, we have seen that there's a great amount of invest, and most of them are family offices. Yeah. They tend to like kind of like come along with us quite a bit. There's a lot of interest in kind of, co-investing and then see how things pan out as such. So that's an interesting trend that we're seeing as well.
And, portfolio construction and / diversification. I mean, we are going through uncertain times going into 2023. And I think you addressed it in earlier comment on you're all optimistic going into this year. With that said, how do you balance between kind of double clicking on your existing portfolio, keeping home safe, and aggressively going and making sure you get the best deal possible? So I think, Vikram, maybe you can address on the early stage segment.
Yeah, so I think it's very important to have a runway, substantial runway to make sure that you are able to reach a certain point before you go back to the market. Especially in today's market, when you know that the market is tough, raising next round is challenging. It's actually proving on the model that we've been doing so far. Very capital efficient founder mindset is what we actually look for at the time of investing. And I think what's important is, when you look at the gross margins and the contribution margins, to see whether in a tough market situation, will your business become profitable if it needs to be? And if you're primarily driven by your top line and just focusing on somehow the acquisition, and you can't turn profitable when you have to, that's when the problem really starts. So I think fortunately in our portfolio, we have constructed a portfolio where, in situations like these, you're able to really focus on your bottom line as compared to top line. That helps a lot. So you don't have to, just take a deal just because, you can't go beyond a certain point. So I think that's very important.
And Anuradha, how about that on the late stage?
So in general, I think like at the later you go, the need for reserving capital for the same company becomes a little bit lesser. Yeah. But having said that, actually, like I would say that we walk this balance between continuing to invest in the founders that we believe deeply in, and to ensure that in this kind of an environment they're not caught without capital, right? Like so that's the and also in terms of like ensuring if we truly believe in them, there might be great opportunities coming up in terms of consolidation. Right. Plays or like the ability for them to build out a bigger business than what they originally thought possible, right? So that's where I see much of the excitement coming for us today, which is about hey, are you looking at opportunities and can we help you in terms of funding and finding those opportunities kind of. So that's how we're kind of thinking about it.
You know, that's perfectly segues into the next conversation in terms of expense management versus growth at all costs, right? How are you advising your portfolio company? That's a big conversation in US for sure. Every single GPs are sitting with their portfolio companies in terms of like, obviously survive and thrive kind of a mode. It reminds me of like COVID day one, except that you know what's coming up, right? Like, so it's just from that standpoint, how are you balancing, what advice are you giving to your portfolio companies? Maybe Anisha and Nitin can talk about the early stage.
Well, I think the great thing about founders now is they're mature enough to realize, or at least they've heard winter is coming, and it's become such a thing after Game of Thrones. But so they're actually conserving cash on their own. They're actually questioning and wondering about it themselves. So it's not like you have to go up to your portfolio companies and say, look, you need to do this. Everybody's seeing it in the market. As a matter of fact, I think they're more scared than, we'd still want them to take a few aggressive bets, and they don't want to do it right now. So the founders, I think, have just gotten to a different level of maturity on where they want to take it. They're also looking at very cool, add-on businesses or pivots that they can take that actually gets them to a certain sweet spot. So, I mean, I don't have to preach to the choir. They know this. I was a founder first. I've seen that cycle. They understand this, and it's great to see founders like that are actually doing this. We've not had anybody in our portfolio company that's really struggling because they overspent on marketing. Actually, we don't invest in those kind of companies.
Right. We can hear you. Yep.
So I think there is some self-selection around who starts a company in these times. So people who are starting companies in these times are not doing it because it's easy to raise money. They're doing it despite that hardship.
Yeah.
So I think they are doing it for the right reasons most of the time. They build businesses more frugally, and they try to not throw money in marketing when they can solve problems through product or technology. So we actually, to your earlier question also, we've learned from the experiences of many of the early pioneers in this room to have a lot more of a reserve ratio. So it's very unusual for a very early stage fund to have 60, 70%. So we have a lot of reserves to help founders go through the next few phases. But I think, like Anisha said, one of the challenges I'm seeing is the opposite. There is almost too much caution.
Mm-hmm.
And you have to remind founders that the goal in the very first days is not just to survive, it's to prove something. Prove the reason for your existence or product market fit or whatever you want to call it. So a lot of meetings are actually pushing them to take a little more risk.
Anupum, what do you see from your lens?
Yeah, it's a great question. Since we're focusing on leverage buyouts, of course, expense management is really important for us because additional cash flow allows us to repay the leverage that we've used to acquire these companies, and also allows us to do bolt-ons and inorganic acquisitions as well that allow, for a greater opportunity set in front of us. But I also wanted to get back to your previous question just about the areas that we're seeing opportunity in. And one thing is that, India started off, kind of in the tech world, really as an outsourcing hub, really kind of taking all of the work that nobody else wanted to do, very kind of grunt work, if you will, and low-end work, low-margin work. But today, India is increasingly moving up the value chain, if you will, really demonstrating that it has capability, whether it's in digital transformation, software engineering, AI, analytics, and other areas. And that's what gets us really excited, because these are real companies that exist in India today that provide an opportunity to showcase what makes the country great and what the opportunities are ahead of us. And so it's really interesting and amazing to see that these companies can exist in India just like they can exist in the West, and be very profitable and lucrative just like they are there as well.
Thank you. Just to wrap it up, one piece of advice that you would give to a founder in your portfolio today to survive and thrive 2023. Vikram, we'll start with you.
I think Nitin said it very well. Actually, if you're out there to solve a problem, and I think you're passionate about solving it, I think you should just focus on solving that problem rather than just change course only because the conditions have changed, etc. Of course, you have to be capital efficient. You have to make sure you do it in the most efficient manner. Focus is very important, so you have to remain focused. And of course, eventually it's all about the teams and the right people. So it's important to just keep your team together, because the most important thing at this time is, because the market is such that, people are worried. So you might actually end up losing some of your most important people. So I think very important to keep your teams together.
Well, most of our founders are actually experienced hands. So I would think a little bit before like really advising them. But if I have to say one thing, I would say that this is a good time to just like build and build like crazy, right? Because there's both opportunity organically there. This is a large market. That opportunity has not gone anywhere. Capital is still available. And the good thing is most of them have raised tons of money. So they are sitting on capital, right? And there is also a lot of inorganic opportunity, and there's maturity amongst the founders who say that, you know, like, hey, I want to finally build what I wanted to start out. So if I don't build it as a standalone business, I'll build it as a part of something else, right? Like, so there are quite a few of those kind of opportunities also coming up. So our, you know, like, there are, you know, constant conversations these days are around how do you build and build more.
And could it be at the late stage build versus buy as well?
Yes,
Right?
absolutely.
This is the time to buy, so Nitin.
I think like all of us have hinted in various ways, statistically, if you're at the early stage, you're probably more likely to succeed, given that you're going through this part of the cycle. So a lot of the advice is, you know, very consistent with what others have said. Think big. Don't let the noise get to you. You know, signal versus noise. I think last 2021, it was the opposite noise. Now it's gone to the other end of the, you know, the pendulum swung the other way. But keep things simple, keep building, and think big.
It's the same. I mean, you know, if you're a founder,
do all the things.
yeah, if you're a founder, you're going to go through cycles, all right? If you're building for the long term, you're going to see that cycle. And it's good to see it. It's good to actually look at things. And you know, the best part, digital is down too. Now's the time maybe you could budget when your CAC was really high. It's probably come down a little bit. So there are pockets of opportunity in this. It's not all morbid. And it's great to go through this cycle. You know, everybody needs a reset. Resets are great. And this is what's happening here right now.
Anupum, final thoughts.
So one thing I think I mentioned to you all outside is that about 4 months ago I was asked to talk about the tech ecosystem in Asia. And I put up a slide on the largest companies by capitalization in Southeast Asia versus India. And one thing that was quite obvious was that companies in both areas, in both jurisdictions if you will, had multi-billion dollars of revenue. However, one thing was also noticeable about India versus the Southeast Asia competitors. And again, these are the largest of large technology-based companies. And that is that Indian companies are profitable, they have cash flows, and they are resilient ultimately. And I think that's a testament to what India can do. I also think that this is something that Indians really do well, which is focusing on making money and on the ability ultimately to generate returns, whether it's thick or thin. And you know, from our perspective, we invest in companies that do have cash flows. And I would always give companies the advice that continue doing more of the same here in India. That's what makes these companies great. Thank you.
Sure, please.
So, you know, one thing that I have noticed, and this was, I'd go to Europe all the time and nobody would give us the time of the day. Seriously, everybody only talked about China all the time. It used to get me because we're such a big economy, right? And the coolest thing to see, and that's a shift, and I think it's great for founders. Now's the time to build because everybody around the world is noticing it. You know, I had so many people from Europe, you know, founders, family offices reach out and talk about it. I think this is the best time to be here in this system and be building and being a part of this system.
I'm moving here, you guys. This is it. The sentiment here, I'm sure Mohanjit can attest to this, sentiment here is a lot more optimistic than what we're hearing back in US. With that said, I think there's facts behind why they're feeling the way they were feeling. Let's give it a round of applause. Thank you, thank you.